3 charts, 3 different markets. Gold, down 25% from January's all-time record, suddenly bouncing. The biggest IPO in history, shedding more than $1.2 trillion of market value in barely a month. And in South Korea, hundreds of thousands of trading accounts wiped out in 2 weeks. Here's the thing nobody tells you. These are not 3 stories, they're one story. And in the next 10 minutes, you'll see how they connect. Quick note before we start. I'm an AI presenter, and this voice is AI generated. Every fact in this video is sourced, and you'll see the source on screen as we go. Nothing here is financial advice. Let's get into it. Let's start in the Middle East. The conflict between the United States and Iran escalated sharply this month. American service members were killed in strikes on a US airbase in Jordan, and Washington has responded with continued strikes of its own. Wars don't just move headlines, they move shipping lanes. Houthi attacks have disrupted the Red Sea, and Brent crude surged above $94 a barrel this week, its highest since early June. And expensive oil is where this stops being a geopolitical story and becomes an economic story. Oil is in the price of everything that gets shipped, farmed, flown, or manufactured. When oil rises, inflation follows. And when inflation threatens to come back, central banks reach for the one tool they have, interest rates. Which brings us to gold, and what a year it's had. In January, gold hit an all-time record, $5,595 an ounce. Then came a crash. At one point, the worst two-day fall since 1983, taking it down roughly 25%, briefly below 4,000. This week, war fears pushed it back to a 2-week high above 4,100. That is the year gold has had. A record, a crash, and now a fragile recovery. Hold that picture. So gold is caught in a tug of war. On one side, fear, conflict, and uncertainty pull money into safe havens. On the other, interest rates. Gold pays you nothing to hold it. So if oil keeps inflation hot and the Federal Reserve leans toward raising rates, that's a headwind. The decision lands Wednesday, July 29th, and futures markets have been pricing real odds of a hike by September. That tension, not the price itself, is the real story in metals right now. Now for the story of the summer. On June 12th, SpaceX went public in the largest IPO in history, priced at $135. Within days, it ripped above 226, briefly making it the 4th most valuable public company on Earth, and its founder the world's first trillionaire. And then, gravity. Wave after wave of selling, until in mid-July, the stock broke below its IPO price, closing near $131, down roughly 45% from the peak. More than $1.2 trillion of value gone. What happened? 2 numbers tell you almost everything. 20 billion, roughly the company's annual revenue. 5 billion, roughly what it lost last year. At the peak, the market was paying over 100 times sales for a company burning cash. This isn't a story about rockets, it's a story about price. Even a great company can be a painful investment at the wrong valuation. Markets have run this script before, from the dot-com era to the SPAC mania of 2021. The technology changes, human behavior doesn't. Now watch the same force hit entire markets. On July 17th, Tokyo's Nikkei plunged 4% in a single session, capping its worst week since April 2025 and entering formal correction territory, down more than 11% from June's record. The trigger? Doubts about the AI chip rally. Memory maker Kioxia fell 16% in one day. It has lost around half its value since briefly overtaking Toyota as Japan's biggest listed company. But the most extreme version is Seoul. South Korea's KOSPI has fallen into a bear market, and here's why it's so violent. 2 companies, Samsung Electronics and SK Hynix, rode the AI memory boom so hard that by late June, they made up a record 60% of the entire index, up from under a quarter at the end of last year. When 2 chip makers are more than half your stock market, the index doesn't track the AI trade. It is the AI trade. And retail investors supercharged it with borrowed money. Here's how that ends. You put in 1 million won, borrow another million, and buy double the shares. Or a leverage fund that doubles the daily move. Then SK Hynix falls 11% in a day. The losses come out of your money first, and your broker demands more cash immediately. That's a margin call. Can pay? They sell your shares at the low, which pushes prices lower, which triggers more margin calls. By mid-July, over 1.2 million Korean accounts had hit margin call thresholds, and roughly 320 to 360,000 accounts were forcibly liquidated. One leveraged SK Hynix fund lost 70% from its peak. Regulators raised margin requirements tenfold. That is what deleveraging looks like. Japan has a second problem, and it's the quieter, scarier one. The yen, at around 162 per dollar, down 11% in a year, despite Tokyo spending tens of billions defending it. Why not just raise rates? Because Japan carries one of the heaviest government debt loads on earth, and higher rates would make servicing it brutally expensive. Policymakers are boxed in. Defend the currency and strain the budget, or protect the budget and watch the currency slide. So connect it all. A war pushes oil above $90. Oil threatens inflation. Inflation pushes central banks toward higher rates. Higher rates puncture the most inflated assets first, $1 trillion space company priced for perfection, and two chip giants carrying an entire country's market on leverage. And for a country that can't raise rates, the pressure escapes through the currency. That's why gold, despite crashing from January's record, has stabilized around $4,000. When investors watch governments struggle, some start asking what money itself is worth. Where does it go from here? Nobody knows. Anyone who says otherwise is selling something. But the next domino is Wednesday, July 29th, the Fed decision. We'll break it down in the next episode. If this helped you see the market more clearly, subscribe one-sourced, hype-free episode like this every week. Final notes. This video's presenter and narration are AI generated. Everything you've heard is education, not advice. We don't know your situation, and nothing here is a recommendation to buy or sell anything. Do your own research, and for personal guidance, talk to a licensed professional. See you at the Fed decision.